back. We are live. Welcome back. The AppliedMMT live stream. Changing it up, pushing it a little earlier in the day. Hopefully our European friends don't have to be up now at 2 a.m. to join us. But yeah, welcome back. Ty, what's going on, man?
Oh, I'm excited to talk about macroeconomics and the markets today with you, Doug.
It is going to be an exciting day. What we got lined up today is we will talk tariffs. Ty and I have been messing around with our kind of simulation model. We'll discuss that a little bit more in more detail. And yeah, we're just going to give some insights in terms of kind of the system dynamic simulation model that we built, what plays out, and yeah, just talk more tariffs. I mean, at this point, they're on the sideline for another 30 days, at least Mexico and Canada. And I mean, it looks like the 10% for China is going to go through. I mean, we'll see what all ends up playing out. I did a video where I kind of covered the two ideas earlier this week that I think are important when it comes to tariffs. That I mean, there's just a direct path to a growth wall, if you will, and that if you really want tariffs to be effective, they in fact do need to get the cost increase needs to get passed on to the consumer. It needs to be inflationary. We'll talk that again. We'll look at the simulation and the model and how that performs. We can also talk not tariffs. We can also talk treasuries. The debt ceiling has been hit. One of the questions that's come up a lot on Twitter recently, and we can kind of look at these questions, is this idea that when the debt ceiling gets hit, that the long end of the curve particularly has a tendency to lower, pushing bond prices up. I think there is. I have been moderately bullish bonds for about a month now myself. In terms of the updates we do over at AppliedMMT, I've thought that was a compelling narrative even before the idea really clicked. That I think there's something to this idea that hitting the debt ceiling might actually push bonds higher. We can definitely talk that. We can also talk sovereign wealth fund, very important, best wealth fund in the world is about to be started. We can talk if that's actually necessary or not. And I saw Stephanie Kilton put an article out on that. I haven't read it yet, but I mean, the title of it was "We Need a Sovereign Wealth Fund the way a fish needs a bike." And I don't know. I don't know if if a fish needs a bike or not. I don't know how that would work, so I'm going to assume that she's being sarcastic there, Ty. I don't know. You can help me out, but
Yeah, no. I think you're thinking it right. There, she's probably being pretty sarcastic.
Okay, good.
Yeah.
So we can talk that, and yeah, anything else chat brings up. And then the other thing too, if there are good questions that come up and whatnot, or if there's anyone that just wants to engage directly, there's demand for it. Let me know in the chat. I'll ask this maybe as we get closer to the end of the live stream, but I'd like to start expanding, maybe do a Twitter X Spaces right after this, if anyone would be up for that. So again, let me know in chat if that's something you are interested in. Ty, I just realized I got to go close my office door. So let me know what's on your mind, right, Ty? Well, I'll be right back.
Well, Chad, as a Canadian, I'd like to declare we won the trade war with Trump a few days ago. So I think everything's going to be okay in that department. Doug, I was just letting the audience know that Canada won the trade war with Trump a few days ago.
Oh, yes.
I think everything's going to be A-okay now.
Yeah. The world has been set right. I'm already seeing some good questions and comments in the chat. Thomas, your name looks familiar, Thomas. Do you interact with me on Twitter? I don't. I mean, welcome to the chat if you're new. Yeah, I think I'm not the history buff, Ty. You probably are more familiar with the outcome of Smoot-Hawley in the 30s, but that was attributed to some negative growth side effects, correct? Let's see. We got Jonathan. Yeah, no. Oh, go ahead.
No, I'm not sure.
Okay.
I'm not too familiar with it.
Okay. Jonathan, welcome, man. Yeah, I've been waiting for a couple of years for it. I'm very happy about this earlier live stream. Oh, I get what you're saying. You're happy about the earlier live stream. I'm like, we've been streaming for many, many years now, but I get what you're saying. You're happy that it's earlier. Yeah. We'll be going even earlier or still. We would have been earlier, but Ty had to go get a manicure. Is that what you pedicure?
Yes,
pedicure.
You got to keep up on things, right? You got to, a healthy body, healthy mind. I want to be beautiful on the inside and the outside.
Yes. Which you do look now. I can tell the manicure worked.
Yeah.
Let's see. We got Brian Engler. Woo, macro. Yes. What makes you, Sly? What makes you so confident the next business cycle is about to start off? Okay. Very good question, Sly. I'll start there. I got a couple. We might go all questions today. I do want to show simulation and whatnot, and some things we've been working on and talk that. The reason that I'm so confident the business cycle is about to start off, and it really just kind of goes back all the way really back now 5 years to what transpired post-COVID to where we're at today. I can't tell you enough how impactful the stimulus regime that took place, both Trump originally with the first wave of stimmy checks, the second wave of stimmy checks with Biden, just the massive deficit spending that took place really over almost a 2-year period from 2020 until 2022 when we finally slowed down. What that really did to the whole balance sheet of the private sector, and we did see an initial kind of burst, kind of a mini credit cycle take off that did top in 2022 and collapsed as fiscal was collapsing in the essentially April of 2022. But that still is residual. That still remains there. That initial kind of momentum, if you will, and for that reason alone, the reason business cycles take off. We go back to just kind of 101 theory 101 is and again I've said this ad nauseum. It's important. It can't be reiterated enough. Is companies, firms take out loans, expand operations, expand output, expand production because they are currently making a profit and they think they can make more of a profit. That is at the heart of our models. That is at the heart of our theory. It is empirically verified. That is kind of the post-Keynesian approach that Ty developed from the likes of Steve Keen, who built that from Minsky and kind of the rest of that train of thought or that school of thought. And when you get a wave of profits, that induces a wave of investment that then creates an upward momentum, an upward reinforcing cycle, right? And that is at the core of really kind of the dynamic system that is our macro economy. And we got that, and then we got that again in 2023, 2024 when the rate hikes occurred. And so that in and of itself, there's just so much momentum from that. And we continue to see everything along the way that you would expect to and want to see that would confirm that, in fact, that next business cycle, and what I'm calling a business cycle really is a placeholder for private credit expansion. In other words, banks creating loans that create deposits, for the sake of creating more production. We are just at, that space where that can take off. And we had a year-long lull of credit expansion where growth was still supported by an exponential growth in that moment in time by deficit spending. And now that deficit spending is starting to level out, maybe even go lower. And in that scenario, if the ingredients are there, you will get a credit boom. And I think that's where we're at, and that's kind of the base case. And it's going to take a heck of a lot of damage fiscally, and by that I just mean the spending stopping and more regulations piled on to really get in the way of the business cycle. So Ty, I don't know if I missed anything in that kind of summary. If there's nuance you want to add, but to me that's why. Keep going.
Yeah, for sure. And the other side of the coin is costs for the economy. So right now, costs are actually subsiding. Just inflation in general is down relative to where it was in 2022, 2023. Rates of are down marginally. So that's the other side of that coin. So profits are up, costs are down. That's a perfect recipe for capital investment. As your capital stock grows, you're able to create more output and employment, and the cycle goes on. Of course, there's always the end game to that. Is I think for me now is when do I see wages start to accelerate? That would be the catalyst for getting to the top of the next credit cycle, which I'm not seeing yet at this point. But I'm on board with Doug. We are at, and I prefer the term credit cycle versus business cycle. And in fact, throughout history, all business cycles have essentially been credit cycles. That's kind of the lubricant of the business cycle. So I would suspect we're at the beginning of a good credit cycle now.
I like it. I like it with cost too going down. The other thing we've seen is just like overall wages. I mean, I've been waiting. Part of the we'll call this the domino effect, or just kind of the causal effect, the chain of causal effect that we're kind of looking for is, we have seen things like wages just fall for a year and a half now, right? And so, I mean, when wages fall, again, Ty, I mean, it's a great point. Costs go down, right? Now we've been waiting for that to turn. In other words, when and it has. I mean, wages have been slightly stabilizing. We've been seeing employment slightly stabilizing. But when you start to see that turn, that's the signal that the business cycle is about to start up. And actually, I mean, this is like the funny part is you saw everyone throughout like 2024, 2023, like seeing what we see is a credit cycle, business cycle that is stabilizing, ready for the next engine to kick on, and all the rest of the kind of non-post Keynesian, your classic macro gurus, they see that as the sky is falling, the key insight, it's kind of like the Minsky insight is, the sky is falling when the credit cycle is really accelerating, right? And I've promised a couple weeks in a row now, I do have a video ready to go that really shows the math of that. But if we accelerate, credit accelerates, like right now, the rate of change of credit is about 3% year-over-year growth of private credit, right? It's about where it's at. If and the total private debt to GDP ratio is, let's say, 145, right? If we get that to grow to 80 over the next, 180 over the next 3 years, so 180% debt to GDP ratio over the next 3 years, very reasonable. If we get a strong credit acceleration, similar to kind of historic accelerations where the growth rate gets to about 10% year over year, maybe on average like 8% year over year during that time period. And so let's say we're at 8 to 10% range around 2027. All it will take at that point in time, assuming like government spending is flat and assuming we're not seeing any major miraculous production efficiency increases or anything like that, it will literally take a percent decrease, not in the total amount of credit being created, but just in the rate of change of credit being created for that to be enough to prick the bubble. And so it is, and that's why you get these scenarios where it seems like every single time everyone is getting bullish at the very end, because they're seeing the signals that are always going to be late and always delayed relative to the credit expansion, that, oh my God, this is the greatest market ever, right? This is like everything is just, unemployment is as close to zero as it can possibly get. The consumer is doing better than ever. Purchasing is happening more than ever. And everyone's bullish. It's at that moment in time that we are most susceptible to a crash, right? Whereas the exact opposite is true when credit is as low as it was through 2020, the rate of change of credit, it's that much more difficult to like suppress credit lower to trigger a sell-off, especially when government spending is where it was at. And so when we get there, 2026 will probably be peaking the cycle. 2027 is probably when we'll get, kind of the crisis to maybe begin to emerge, assuming all things go as we expect them to go. But that's when you want to be worried, right? Is when that credit cycle is at its top, and especially if deficit spending does give way. That is when the peak to the cycle will end up being. Next question on board here, and then we will get going with the sims and stuff. But next question on board are the simulations kind of the basic concepts. I'll just read it. Are there simulations of MMT basic concepts in Steve Keen's Minsky software? I thought you were asking about ours. Yeah, Steve Keen has some basic stuff on his website. If you hit me up in the comment after the video is published, let me know, and I can definitely point you to what I think are some of the better kind of toy models that he's created over time. Eddie, let's see. How are you feeling about markets these next couple of months, including the tax drain? I have been bullish through this kind of consolidation period. I think we're going to break higher. This is then also probably a great time to just go ahead and plug AppliedMMT. Just dropped my update today. For those active traders, active investors out there, went through a lot of detail in terms of where I think things are headed. Overall, though, even through this time period, I've remained pretty bullish, and I think that at the end of the day, I haven't seen enough damage from what Trump has promised from a spending cut standpoint to think that at this point the kind of the status quo is going to be disrupted. All right, Ty, let's see. Are more questions coming in? Just getting into learning MMT now. Yeah, great, Bill. Low bar Bill. Yeah, I like it, man. Thanks for joining, Low bar Bill. What are the second order effects of removing the federal income tax? Trump wants to fund the government via tariffs, but does removing the federal income tax give states more leeway to increase taxes? It's kind of interesting. I don't know. Ty, do you have any immediate thoughts about removing the income tax and second order effects and that sort of thing?
It's never going to happen because, for one, the amount of tariffs versus payroll taxes and income, it's insignificant now. It worked, and this is something I came up in a conversation I had a few days ago. It worked in the 19th century, right? Because trade, bringing in stuff, everything had to come into North America to get production going, right? So that kind of worked as an income source for the government. That's so different now. So you could never offset with tariffs and replace like an income tax. It would never work out for the government. Even if Doge or whatever Elon's calling his pseudo little department made $1 billion in cuts, it's still not enough to offset it. So it's not even a realistic thing. It's nice. I know there's the libertarian movement down in the States where, you guys got strapped with an income tax during World War II, and it just never went away. And I get that, and I get that feeling, but mechanically, just to have that proper drain on reserves in the system, tariffs, it's just not a big enough chunk to do it. So it's just not practical, and it'll never happen.
Never say never. I would be all for it. I mean, I'm rooting to get rid of the income tax. But Ty, I think what you're saying is if you actually want a one-for-one offset, right? So, I mean, whatever the deficit was for fiscal year 24, whatever it was, 1.8, 1.9 trillion. If you want to at least average that deficit going forward, right, or lower that deficit, I mean, if that's Trump's stated goal, there's no way that what you're saying is there's no way that tariffs could ever offset.
The revenue from it'd be the complete opposite of what Trump wants.
Trump would want. You're just saying you would explode the deficit, is what you're saying. Yeah.
Just simple math.
I mean, as someone who is currently highly leveraged long, I would be all for it. It would be a great day, but we'll find out. We'll find out if it ends up happening. Yeah, I mean, the math that came out from the tariffs that were at least proposed originally was like $280 billion in terms of revenue generated from the tariffs in the first fiscal year that they'd be implemented. Obviously, they went away, so that becomes a bit of a moot point. All right, good question. Let's see. We'll come back. I'm seeing just a question pop up. I haven't read it, but just about empirical data on whether tariffs lead to other things. We can talk about that. Let's do this. We'll bring that back up in a second. What I want to do is I'm going to bring up. First, let's just say first things first. We've done. I'm gonna hit run while this is brought up, and we can discuss it as we go along. We are going to rename. We are going to rename what we originally called Messy, then we called DeepMMT2. It is just, as we continue to develop this thing, it just kind of continues to grow beyond even maybe what we thought it could end up being. And it is much more broad than I think we even originally thought that it could be as we set out. So we're going to just rename, and we'll have the official kind of post out soon where we really just give a deep dive into the whole idea and the technology behind what we're building. But we're going to rename this entire platform that we showed off a few times, Deep Minsky. And I just think it is the best name given what it is that it is actually doing. And at the heart of this, if you are new and you're just kind of watching this, at the heart of it is the system dynamic model that Ty has built out that really just simulates the entire macroeconomy. And what is so different about what we're now going to call Deep Minsky is relative to anything else that's out there is it really is a simulation tool, right? We are not in any way like back testing, statistically fitting historical data in any way, right? Everything you're seeing here is created by us identifying every single one of these parameters that defines the underlying theory of the macroeconomy, and then setting the various policy decisions that are being made. So kind of the real variables, putting those through this extensive 30,000 plus feedback loop, hundreds of variables connected to each other, system dynamic model, and actually simulating the macroeconomy from here. So we can then, whether we just want to run simulations like we're going to do today to just see what the impact is of any given policy decision, or what we'll show you in a second, which is just actually now dial in each one of the various policy decisions, each one of the various parameters to fit today, where the data is at today, to actually forecast where growth is headed, where inflation's headed, that sort of thing. Whatever we're doing, we're using the simulation engine to determine that. We're not creating some sort of like fitting model that then extrapolates forward. And so at the heart of this, I can't emphasize enough, everything you're seeing that is being done is created endogenously from the simulation model itself, and whatever inputs we make are simply because, and the outcomes that come from those inputs are because this thing is a real simulator and not again some statistical tool. So what I've done, Ty, and one of the things Ty really likes to do, he's really fond of me just in real time throwing things at him in the simulator and seeing if they work, and then having him explain it in real time. Yeah, he's never been to me before, gone to me and said, Doug, we just can't do this. Like we need to prepare ahead of time to make sure it all functions right, and to think it through. So what we're going to do is low bar bill. It's a deep DEEP Minsky. Yeah, we'll have back to that point. I know I was just kind of rambling, fire hosing there. We will have like an official white paper out that explains the technology. We're adding in some new elements. In fact, actually, just to kind of get myself off topic one more time. If you head over, and this is free, you don't even have to pay for this. This is free. If you are interested, we do offer for absolutely nothing the Deep MMT preview, and I don't even think you need to even sign up for a free account, so you can see just the next month or two of the forecast. Obviously, if you are an AppliedMMT Pro member, you'll get the look further out in terms of what the forecasts are and the weekly updates and everything that we put context to and everything like that. But if you head on over there, Deep MMT2 preview, soon to be called Deep Minsky preview, we will, it's over there. And again, like I said, I don't even think you just have to sign up for a free account or anything like that. You can just jump on that and take a look at that. But back to the fun for today's stream. Martin Bach, yeah, man, glad you could catch it live. Glad a lot of you are catching it live. For the first time. Like I said at the outset, two things. One, if you're interested, we'll probably go live on Spaces X after if you have any questions, just kind of want to engage. And then two, we'll be even liver sooner in weeks to come. So get subscribed, notification bell on, all that good sort of stuff. Yeah, let's do this. If you're interested in jumping over to Spaces after this, and I'd be glad to pull people up to just kind of engage, have questions and that sort of thing. Hit the like button. That will show me that is something that is wanted. And if you're not interested in that, just go ahead and hit the like button again as well, and then that will help me understand what you want. Simulator time. What I did is I just set up a basic simulation here that just establishes a baseline business cycle, right? And what we're going to do is we're going to establish this baseline business cycle. And again, everything you're seeing here, simulated, created from the model itself. And, if you're familiar with Steve Keen or anything that Ty's done on his channel and whatnot over at Relearning Economics, you'll know some of the stuff that he's put together in the past with the deep learning, or I'm sorry, with the system dynamic model. So we've taken that core, what he called his national model, made it into this what we're calling now kind of deep Minsky model. We're going to be adding some elements to this as well soon, but we now kind of have a baseline business cycle. You can just see, I mean, inflation is cycling, and we have a peak and a trough every about 2 years. You have I changed nominal output because it shows a little bit better than real for this scenario, but we finally get these just kind of stabilizing business cycles, booms, busts, unemployment pushing higher and lower, and everything that we talked about at the outset of the stream about that whole idea that the credit expands, that creates a boom, it eventually busts, that creates the bust, that all those sort of things end up playing out. Down here on the bottom right is, and this is really cool, this is new, and we're still refining this, but it has been very accurate. And Ty, I told you before we went live that there was something kind of interesting that took place. It actually took place in the equity return, but because in the simulation model we're able, we have to, just by the nature of the way the model works, capture essentially every variable in the macroeconomy add up the total equity value of the entire private sector. We can create a kind of a quasi market equity return module that we track. And then again, I think we can show this to you in a minute when we show up kind of the real time, but it is amazing how close this thing tracks, and really how close the actual, and when I say equity, I really just kind of mean the return of the stock market, right, where the stock market is at in its broadest measure, so like NYSE or something like that, which would be the broadest measure of the private sector, how close it ends up getting to some of even just kind of small variations. So those are the four that we're going to look at, and again, just a classic boom-bust business cycle. And what we want to do now, and I'm setting this up to induce the kind of shock, if you will, for the tariffs to take place in this version 2031.5, so June of 2031. Now, this is a qualitative model, right? This isn't, it is to just demonstrate and simulate what the characteristics are of various policy decisions. And so don't pay attention necessarily. I mean, just kind of think of this as year 1, year 2, year 3, year 4, whatever. Don't think that this is like the years here and now. But what we've done is we've added in the firm import tax, because it's going to be the firms themselves that are going to pay the tax. And here's what's wild. Now, Ty, correct me if I'm wrong here, because when I was kind of prepping for this, I'm under the impression that this is taxing the entire flow of imports that are coming in, correct? So correct. So what I'll do is I'll pull up this chart right here on Fred, imports of goods and services. This is the equivalency to what is actually being taxed. So we're at, right around 4 trillion of imported goods. And in our model, this kind of, I don't want to call it a toy model because it's far beyond that, but this model right here is maybe not exactly 1-to-1 in terms of like that volume of a trade deficit, but suffice to say, I think it's based on kind of what I was seeing in the background, Ty. It makes sense that about a 3%, maybe 2.5% would be the equivalency of what the tariff hit would have been. I don't know if you came to the same conclusion, but we're going to do 3% tax. So again, Chad, just so you're tracking here as to why I'm setting it at 3, we're taxing the entire flow of imports, not to try and match what the tariff would be on Canada, China, Mexico had it gone through. So we're going to implement that. We're going to implement that right at 2031 and a half. So June 2031, we will run that simulation and we'll see. Stop being long-winded. We'll see it's hard for me to stop being long-winded, Mac, but it is running in the background. We'll see the shocking conclusion of that. And I probably overdid it, Ty. I mean, maybe 2% might have been it. But in this simulation, so this would probably be the equivalency, I guess, to probably what, like a $400 billion total import tax would be. You just get a complete collapse of everything, really. You get a complete collapse of nominal output. Inflation completely collapses. Unemployment goes up. It is just a direct hit to growth. There's no other way to put it. I mean, Ty, maybe you can talk through the mechanics of this in a little bit more detail, but all I'm seeing here is just an immediate hit to growth.
Yeah, so it's essentially just taxing your business community. That's essentially would be the same thing. So the first, like, if we just kind of go through with the basic effects, what gets impacted first is corporate profits, firm profits. They go down. Firms have less to invest. Your capital stock doesn't grow as much. And when I say capital stock, because I know we deal a lot with finance, I'm talking about real equipment and machinery that can produce things, right? So if that grows more slowly over time, then output grows more slowly over time. What do you need with output? Well, there's one of the factors of production is labor. So if output's growing slower, labor's growing slower, right? So that's what you're seeing in the results right away. Now, it's very easy to say, well, this is going to drive costs up. And that's kind of what I expected when I added this feature last week. That's what was in my mind. Okay, we're going to see some form of inflation. Don't know how much. And so when I finally had it finished and I did a little test, it was deflationary. And at first I thought, oh, geez, well, I've screwed up an equation somewhere. This can't be right. But as I sit back, and I'm sorry, guys, I have a bit of a cold going on here, so I'm a little short-winded. But when I sat back and thought about it, I realized, well, no, this kind of actually goes down the MMT lane, where taxes are basically a countermeasure against inflation, right? Now, you can't just jam up taxes every time there's an inflation scare or anything like that. But nonetheless, the theory says, higher taxes is deflationary because you're taking out reserves from the system and you're taking out bank credit, you're deleting it. And that's the same thing that's kind of happening with the import tax, we'll call it, tariffs. And that becomes actually deflationary. Now, this is an aggregate model, so it's looking at everything in whole. There is no doubt in my mind, for instance, if there was tariffs, a 10% tariff on Canadian oil, your energy costs would go up. But in aggregate, you would have other products falling, right? And you would have employment falling, right? And output falling. You're depressing your economy. You're overtaxing your economy through tariffs. So when I sat back and just made sure, first I looked at the math and I'm like, no, I've done this all correctly. It becomes quite apparent that actually tariffs, it would be deflationary. But I really need to stress that, yes, indeed, some products would go up massively and energy would be one of them.
So I think the main takeaway, and some of the kind of the Twitter debates and whatnot that I've gotten into specifically with regards to the impact of tariffs is on a micro level, how that plays out agent by agent, sector by sector, like that always remains to be seen. But on a macro level, just the base case is exactly what Ty just expressed. Is it's just an increase in cost, decrease in revenue and income, and that is just a recipe to slow down growth. So Ty, while you were talking, what I did is I tried to just pull it back just a little bit to kind of make it a little bit more reasonable in terms of the hit. So I switched it back to about 1% tariff, and we still see everything that we saw. What I really want to zoom in on here, though, this is kind of cool, is the immediate shock. Just keep this in the back of your mind. The immediate shock following the tariffs to the equity before it picks back up its cycle and really runs hot for a little while. Just keep that in the back of your mind, okay? We're going to go over a few charts here, and then we'll kind of loop back to this. And again, this is like every time we go through this, I get so excited. Ty's like, well, yeah, Doug, I built this model to do exactly that, and you're just confirming exactly what it is that I set out to do. I don't see why you're so excited. I told you it would do that, but go ahead, get excited. So that's how I usually that's my Ty impression. It's usually how
that's exactly how I sound.
Yes,
he's nailed it.
Yes. What I want to do is just point out a couple things. So we're looking at CPI. Actually, let's jump here first. Here is the moving average. It's a 180-day moving average, and the original Trump tariffs, I think, went into effect in like mid to late 2018, and you can see starting and again, so this is a moving average, so it's a little bit delayed, but you really see right at the end of 2018 the big pickup in tariffs. So I'm just getting this straight from the daily Treasury statement, and if you're interested and you don't, here's today's daily Treasury statement. You can actually just see somewhere customs. You can just see it tracked real time, and so it is sporadic year over year change and all that sort of stuff. So I did have to smooth it out just a bit. But here's the moving average and that initial burst higher 2018. And following that, what you end up seeing is into 2019, you just really see GDP cool, just as our model showed that it would, and then the business cycle picks back up. So it's almost like a one-off shock. And then the second thing is CPI begins to cool, and then eventually as the business cycle picks back up at the back end, it too ends up kind of winning out. Here's where the fun part gets. And again, remember, we said following tariffs, immediate shock to markets, and then markets go ahead and pick back up. And lo and behold, 2018 tariffs start right at the end of September, October, and I know there is a lot more going on during this time frame to cause what it is that we see play out. But sudden correction in markets followed by a very quick rebound, and then obviously COVID would hit about a year and a half, 2 years later, and then changed everything. But suffice to say, I think looking at just the base case simulation, that empirically everything that the simulation is showing shows up in reality. And I feel pretty darn confident that if tariffs end up getting enacted, that the response will be, or the outcome will be, a slowdown in growth, a slowdown in inflation. Markets would likely take a hit, and then we'd be off back to the races again. I mean, depending on what ended up playing out. And I think the other thing too that is important, with tariffs is it is a one-time adjustment, right? It's not like a kind of reinforcing inflation scenario, right, where higher rates just print a ton of money and then you can get a spiral up. I mean, this is a one-off. It might take time to fully digest, but it is a bit different than something that's more structural, that changes, that reinforces itself. So I mean, there is, I think it's part of the explanation as to why you do just see the cycle pick back higher or pick back up higher. One final thing to note that I'll point out here is, and I've been talking to Deerpoint Macro on Twitter a bit about this. If you're interested, over at his Substack, he had a really neat article on tariffs that really just kind of pointed out the same thing empirically. He was able to find that tariffs really just kind of act counterintuitively to what it is you would think they do. So to tie up the whole tariff discussion, I really just think that if your goal is to slow down growth, is to slow down production, is to really just slow the macroeconomy down and just kind of end up in a less productive space than you started with, like if that's your goal, then I guess tariffs are a good thing. But I mean, if your goal is to continue to increase output, to continue to increase growth, to continue to innovate, all that sort of stuff that a capitalist economy would want to do, I think tariffs are really the most counterproductive way to get there. I would argue that probably the greatest production boom that we've ever seen was actually during 2021, 2022, following the stimulus, all that sort of stuff. That sort of, kind of like, yeah, hey, if we want to build more cars, just directly invest in more car building, right? Don't stall out the, no pun intended, don't stall out the growth engine in hopes that is somehow going to just magically make auto manufacturers want to onboard production in the U.S. Just spend to do it. If that's your goal, you could just put your hands up and say, no, I don't want to run a command economy, and I just am going to set some basic, spending ideas, and that's that. I'm not going to actually try and control this. That's fine. But if you're looking to do what it seems like the Trump administration wants to do, which is really just kind of control the economy and get it done, then I just don't think. I think there's a very countermeasure to what it is they're trying to do. I don't know, Ty, do you got any thoughts on that?
Yeah, for sure. So the mainstream thought is obviously you impose these tariffs and that changes the behaviors of your domestic firms. So they just start producing things domestically. But that is not probably not really what's going to happen, right? They'll adjust their balance sheet. They might pass off some costs, right? But they would just simply kind of adjust. I've always thought, if you're going to take those tariffs in, you turn right around and you invest that into projects where you build out your capital capacity of your nation, right? So you would take those funds, give them out as grants under the condition, hey, you're going to build a factory with this. You don't have to pay me back if you build that factory and start producing X, Y, and Z. Domestically, so it's two sides of a coin again, right? Yeah, the tariffs themselves, great, okay. There might be some behavioral changes, but really you need to take those funds and recycle it into some direct investment to get private corporations to build out their capital capacity.
I agree. I'm on board.
But we know that kind of goes against the whole Trump Elon thing. So it would never work, right? So tariffs are just a terrible, terrible thing in the 21st century. They don't serve much of a purpose, right? They'll never work as one argument to offset income taxes. We've done the math on that quickly. Back of the envelope, it doesn't offset that, so it don't work for that. It's not going to change the behavior of well-established global supply chains that stretch across the globe, right? It's not going to do that unless you have your federal government fully backing up your domestic firms to go hard. Treat it like a World War II event, right? Mm-hmm. Treat it like that, right? Where you had war bonds. So instead of the tariffs, it was war bonds. Well, that just reduced demand in one part of the economy, so the government could employ in another area. If you were to treat tariffs like that, where, okay, instead of the war bonds, you're now using tariffs to reduce demand in one area, then the government steps in and starts directing resources to build up the capital capacity. And again, when I say capital, I mean real fixed machinery that actually produces stuff, not financial capital. Then there's an argument to be made. And if America was doing that, and that, I'd almost be on board with that. But we know that's not Trump's MO.
Yep. Yep.
The government spending part. So that's where it just kind of falls flat.
We do know the one thing that tariffs did accomplish, though, is it made Canada stand down. So, not to contradict your earlier statement.
So I just
there is words.
I no there is right on the government of Canada's website where on December 17th we announced that we'd spend 1.3 billion on the border because we knew Trump was coming in, so we were being proactive.
Yeah, that's what I heard is you got ahead of the game.
Plus we are doing it for us, not Trump. It's just normal routine government spending, but it complemented what Trump wanted. All Trudeau did a few days ago was went down, or it was a phone call in this case, and said, yeah, we just spent $1.3 billion. And something he announced a month before. So that's kind of the last laugh. And the same thing with the Mexican president. I can't remember her name, where there's 10,000 troops, Mexican troops now on the border. There's not going to be an additional 10,000 there. There's already 15,000. The Mexican president just informed Trump, we have 15,000 Mexican troops on the border. And then Trump took that as, oh, I've won. The Mexicans have put 10,000 troops on the border to help border security, right? So these are the Trump victories.
They're great victories, okay? They're very big victories, okay? The best kinds of victories. Let's see. Tariffs are off the board now. Never to return until March. And then April. And then June. Next up, though, I want to talk Treasuries. A couple weeks ago now. When was this? January 17th. Extraordinary measures took place to stop the U.S. from defaulting because we hit the debt ceiling. And the implication of this is let's go back. Let's go back to kind of post-Keynesian MMT 101. And that is something I've already mentioned 2 or 3 times, but it's really important. And yet 95% of the macro world doesn't get this. When the government spends, that adds assets to the private sector. So if we never issue debt whatsoever, right? If the government wanted something, a tank from Tommy's Tanks or something like that, the government would issue reserves for that tank, right? Those reserves would end up on Tommy the Tank's bank's, God, this is going to be a tongue twister, Tommy the Tank's bank's balance sheet. And Tommy the Tank maker, he would not have a tank anymore, but he would now have a deposit that would equal the amount of those $100 worth of reserves, right? And so now in the financial system, there'd be $100 worth of reserves, there'd be $100 worth of deposits, and then Tommy the Tank maker would have $100. And in that world, there was, at one point, no financial assets. It's just Tommy the Tank maker with his tank. And now there is financial assets. Tommy the Tank has a deposit and offset by reserves. Now the problem is there's a law that says the government can't actually just do it that way, right? Is what they have to do is they first have to fill up this thing called the TGA, which allows them to then spend those reserves into existence and acquire what it is that they want to do. And in order to fill that TGA up, they have to issue bonds. And then this is treasuries. And this issuance, this total stock of issuance is what we call the national debt. And eventually we hit a debt. We put ourselves a debt. There's a debt limit. So anytime we spend, we have to go issue these things to offset the reserve drain in the TGA. And we go ahead and fit this law in that says that we have to agree that we're going to agree to do what it is that we said we were going to do every 6 months or so. And this is what we hit, right? So you can actually see this in the TGA. That's actually why I had the TGA pulled up. Here is in the bottom of withdrawals and deposits, you can actually see what was redeemed that day and what was issued that day in debt issuance. Now, what it can, what the Treasury can do is it can roll over its existing debt. So that's why you'll see just very small amounts on the daily Treasury statement day in and day out of issuance and redemption. But what you're not going to see if you scroll further down is the debt itself in table 3C, the debt itself get any closer to the statutory debt limit. In this case, we're essentially butted right up against there. And this is what extraordinary measures are. And I actually don't know the exact mechanism by which the Fed in the Treasury use to go ahead and add, but I know it's limited, and eventually they do have to unsuspend the debt limit. But the point is, why all this matters is, and this is pointed out, and a few people have brought this to my attention, is that what we've seen historically play out is, I think like 4 out of the 5 times now this has played out, we actually see yields collapse, for a lack of a better word, especially on the long end. And that is exactly what we've seen play out. And the question is, why? Why is this playing out this way? Why does this pattern continue to play out? And I, by the way, a tweet that I just pulled up, Bill Wabuffo, great follow, really smart guy, very much in line with, he wouldn't call himself an MMTer, but he's very much in line with kind of this balance sheet approach. And I think the answer is, and makes a ton of sense to me, is those reserves, like the government still has to spend, right? The government still has to ship out Social Security checks. It still has to pay for healthcare, Medicare, all that sort of stuff. The government has statutory. Well, as it turns out, they actually don't have to. I mean, as it turns out, someone can just take control of the Treasury payment system and just stop the payments. But supposedly, according to law, the Treasury has to go ahead and make those payments, and since those payments are going out, that means then, going back to the original kind of mechanics of how everything are taking place, is that then when the government's spending, that's adding those reserves. And because of the institutional structure of the way the macroeconomy works, there is then always a demand to get those reserves into Treasuries, right? And this is where, when the Treasury issuance stops, because we're at the debt ceiling, right? We can't issue new Treasuries. We're essentially, creating a shortage of Treasuries while that debt ceiling is there. But we're still adding the reserves out, adding to the buying pressure that's there. And that is, I think, the explanation as to why we're seeing bonds really take off here, amongst other things. Ty, I'll let you jump in. I don't know if you have any thoughts mechanically, if there's any nuance I should add to any of that, but I also think there might be one other reason as well that's kind of worth talking about.
No, that sounds reasonable. What's being described there? You're starving the market of an asset, and it's driving its price up. So that sounds reasonable. So if you've got more to add, I'm learning here from you, Doug.
Great.
Right?
Yeah.
So keep teaching me.
Okay. So I really think it's that simple. Now, the other reason too why I just think that bonds likely have been rallying a bit here, and even before it kind of dawned on me that I think that argument is right. We were probably at this inflection point anyway, where we were going to kind of shift gears as it's. If you just take away all other kind of things, I think what happens let me take a step back. The Fed is the monopoly price setter of interest rates, right? And what the market is doing when it's looking at bonds is it's effectively trying to front run what it is it thinks the Fed is going to do. So it's going to look out at the exact same thing that the Fed, even if it doesn't realize this is what it's doing, this is exactly what it does. The empirical data proves this. Bond yields are essentially just front running growth, inflation, and unemployment. Right. And, usually what takes place in kind of a historical business cycle is, because the Fed has this backwards idea that it should lower rates to gin up growth or whatever. not backwards idea, but I mean, they have this idea that's what they have to do, that when you start to see growth really hit the skids and all that sort of stuff, that's when rates drop and you'll see bonds take off even before the Fed actually says, yeah, we're going to cut at this point. And then the exact opposite plays out when things really start to heat up because the Fed thinks they need to hike rates to go ahead and stop that heating. Then that's when you start to see yields really start to take off and then bonds start to drop. And I think what's happening is we're in this transition period where at this point, we're kind of seeing this lull in inflation. We're not seeing growth really take off. You're seeing the Fed kind of mid-cycle wanting to do these kind of mid-cycle cuts just to make sure things don't drop too far, too fast, too far. And so I think we're kind of there to allow the long end of the curve. And again, what happens with the long end of the curve is you're really seeing what the market thinks, super far out growth is going to look like relative to today. And so at this point, I think what the market is saying is, I don't think growth is going to be as hot as we originally thought that it was. We need to correct back to kind of levels that we were at 6 months ago, a year ago, 2 years ago, and then reassess. And usually what ends up happening is then you get, and I think this is what's going to end up playing out, then you get, the real firing of the next growth cycle, the real firing of the next kind of endogenous growth cycle, which will probably really take off by the end of 2025. And then that's when this will all reverse course, assuming Trump hasn't taken full control of the Fed and just setting interest rates himself. But then you'll start to see not only growth take off, but then the knock-on effects eventually of inflation to take off. And so, let's say we rallied to like 103 on TLT, we'll hit that ceiling, then the market will understand that, oh God, we went too far. We're actually going to get maybe a growth inflation wave. Now rates need to come back up, bonds are going to drop down, and we'll reverse course. And so what I think is we are just at that inflection point where the market is just anticipating right now slightly more steady growth than expected, or than had been originally expected just a few months ago. But 6 months, 9 months, a year down the road, we might actually reverse course. And that's kind of where I'm thinking we're headed at this point in time, on top of probably what kickstarted this whole thing, which was the just pure mechanics of what happens when you hit the debt ceiling. So there's my lecture on why I think bonds have a little space to run right now. Go for it.
Well, are we still on this, or there's just a few questions?
Yeah, we can jump to questions. Let's jump to questions.
Chats. I think Vladimir in the United States. So he's got the question here. Government spends first, then issues securities sequence. In the United States, this is self-imposed. The TGA cannot drop below zero, although it could mechanically quite easily. We could overdraft it. Yes. So in the United States, they have a weekly Treasury auctions, right? And they are quite coordinated with the New York Fed. So the New York Fed is quite aware of the issuance that's going to be sold to primary dealers. So the New York Fed will always make sure primary dealers have sufficient amount of reserves to buy an upcoming auction. So the way they do that is just through open market operations. They'll buy some of the old Treasury assets that were released in the past. That gives the primary dealers, i.e. banks, the reserves to purchase at the next auction. The TGA has to be above zero in order for the spending to happen. So the sequence really is the Treasury auction first. Now, I know if you consolidate the Federal Reserve and the federal government into one entity, then, the spending comes first because the Fed is creating the reserves for the primary dealers to buy the bonds, the treasuries, and then the TGA has them. Then the TGA just spends them back to the banks as reserves, and then accounts are marked up in the commercial banking sector. So I just want to point that out, Vladimir. Like on a technical standpoint, the Treasury auction has to happen first because there's the self-imposed rule that the TGA cannot drop below zero. Another question I hope I'm not getting this. Doug, correct me if I'm wrong. Jonathan, Jonathan, is that how you say his first name? And I'm not even.
Jonathan. Yeah.
Oh, maybe he forgot the
Well, no,
H there.
he's probably just European. Probably makes sense to him.
Sorry, my bad. I'm not good with European names, clearly. So he's got his question. Can you clarify the relationship between reserves and dollars? Does created reserves equal created dollars? It is my understanding that this is not the case. And this is the problem with economics. Terminology is loose around everything. Reserves are just accounts that banks hold at the central bank, and the government will hold an account there, and any other big government institution. Those are reserves. Those are US dollars. So there's digital dollars, right? It used to be in the olden days, a lot more of that was physical currency. So banks would have physical currency reserves in their bank vaults, right? And those would be called reserves too. They are US dollars. What gets a little bit confusing is then banks have their own bank credit, right? And those are US dollars too. They can be redeemed for US dollars. So yes, like your question, that they can be a different amount because reserves don't represent all the potential dollars in the system. You also have bank credit, which is all of the commercial bank accounts that private commercial banks create. So that's my answer to that.
I like your answer.
I scratched my itch. I just
No.
had
It
to.
was good. It was good. To be honest, I was getting ready to the spaces. To go, Chad. Just a reminder here. If right when we're done, like quite literally right when we're done, we will. I'm getting it set right now. We will jump. I will start a spaces. I hope spaces. I can get spaces to work on desktop because I really don't want to have to jump on my phone. But if it takes a minute to get it going, we'll get a spaces going. If you had questions unanswered or you have other thoughts, whatever, jump on. As long as they are, within line of kind of macro finance, that sort of thing, we will absolutely discuss. But I will answer these last two questions real quick. Question: given the uncertainty about tariffs and the mechanics of bond market response to the debt ceiling, would now be time to rotate from stocks into treasuries? I'm still bullish stocks, and I've been bullish tariffs. So make of that what you will. I have been very bullish both. I rarely touch treasuries, but given everything, it made sense. So yeah, that's my short answer. And then finally, the last thing, Michael, Ty, if you hit on this, I'm sorry, but Michael's point is really good here. That the repo market is. I mean, obviously we're flush with reserves, but the repo market is what's necessary to get that. The reserve ad, they have the whole thing set up for. Let's put it this way: the Treasury, the Fed, the banks, everyone is aware that the primary dealers, everyone is aware that the system is messed up, and they just create a workaround for a dumb law. So, yep, that is called the repo market. And then reserves can get so plentiful, and money market funds need access to the higher interest rate that the Fed is offering, that they actually then do what's called a reverse repo to help facilitate money market funds not completely collapse, ironically, so they can get access to the goodies. So a lot going on there. Kind of fun. All right, chat. I've had a lot of fun. Today was good. Hit that like button on the way out. Come on, we can get more than 9 likes. Was I that bad today? I know I was long-winded, and I agree. I'll make it better next time. I'll work on.
Hold on. Who was that long? Oh, Mac Shees.
Yeah.
Shees.
Yeah.
Mac.
I mean, he's not wrong. I have a fire hose in the back of my throat, so I can't help myself.
It's okay. It's okay. Like You know what? That's you got to carry the show. This is your live stream. You got to carry it. It would be me like watching the hockey game and the play-by-play guy was, you know what? I just feel like I'm too long-winded. I'm not going to call 10 minutes of the first period.
Yeah. What's
Right?
hockey? What's hockey?
Wow.
Sorry, man. Sorry, I'm kidding. I'm a Red Wings fan, of course. Okay, I'm from Michigan. I know what this game is. Chat, we had a lot of fun. Head on over to x.com. Twitter, soccer. Yeah, soccer on ice. Okay, I know what that is. That makes more sense. Soccer on ice. Yeah. Head on over there. Yeah. Low bar Bill, this is just really off topic. Low bar Bill, if you're still watching, head over to Spaces. I got questions for you. Otherwise, everyone, thanks for showing up. Yeah, as always, good trading, everyone. I'll see you on Spaces. Just a second. Good trading, everyone, and we'll talk to you next time. Bye-bye.